Students, am I audible? Okay. So good afternoon to everyone. So yesterday's session we have discussed with the basic nature and scope of economics and demand, and there are various types of elasticity of demand, price elasticity, income, and cross elasticity of demand, point and arc elasticity of demand. Now today's session determinants of price elasticity of demand. So there are various determinants are there which influencing the price elasticity of demand. In this, point number 1, availability of substitutes. So availability of substitutes, for demand, closed substitutes, always elastic demand is available. Elastic demand is applicable for closed substitutes. Point number 2, position of commodity in consumer budget. So here, position of commodity in consumer budget which represents income. So proportion of income spent on goods higher than the demand. Income spent on goods higher than the demand, therefore it is elastic demand. So the elastic demand here also, which represents the elastic demand. And third one, nature, there are two important points. One is, for luxury goods, always elastic. The meaning of elastic, the quantity demanded possibility to change when the price is large. Inelastic demand means same point whereas the price is less. So even in the yesterday's class I have told the difference between the elastic and inelastic demand. So for luxury goods, even the price is more, so based on the price is more, there will be a changes in the demand. For necessities or necessary goods, always inelastic. Even a small change in price which influence the demand, it is called as inelastic demand. Say for example matchbox, whereas the price is going to be changed very small, so based on that there will be a demand in the market. So even the small change, it won't influence the consumers in order to buy the commodity. But at the same time, whereas prestigious goods, luxury goods, even the price is more, there are some consumers, they will show interest in buying those type of goods. So even the price increases, there will be a demand also, the demand also will be increased. But for the luxury goods, the same demand increases, the price also will be increases with regard to specific amount of consumers. But for necessary goods, even the small change in price which influence the demand. So luxury goods means elastic, necessary goods for inelastic. Number of uses of commodity. Higher says lower. For example, milk, then it is elastic. Even the price is large, but there is no other way where the people, they may show interest in order to procuring the milk. The reason is that the commodity can be used for different purpose. Same way for lower, example pulses, which comes under elastic demand. Consumer habits. For the consumer habits, again here one is brand loyal and the another one is not brand loyal. So here for this, price is sensitive, but for this, price is insensitive, which represents this one, which represents inelastic, but here it is used to represent elastic. So consumer habits, it may goes on changes. There are some people where they will show the interest in buying the commodity, especially branded one. Other set of group of people, they will see the price and they will show the interest in purchasing the commodity, but for that the price is elastic. When comparing to brand as well as non-brand, most of the people comparing with this brand loyal and the most very much expensive product. Instead of that, the people, they may show interest in purchasing the product where the price is very less. It depends upon the income of the consumers. So here brand loyal, the price is sensitive, it is used to comes under inelastic demand, whereas the other one comes under elastic demand. Next one is tied demand. So what is the meaning of tied demands? Tied demand means goods which are dependent on some other goods. For this, demand is inelastic, but the same way autonomous goods independent. So here for this demand, it is elastic. Say for example, raw material is required for production. So this raw material required for production is an example. For rendering with a good amount of production, the raw materials is required. So here dependent on some other goods. The production which totally depend on raw materials, with the help of raw materials only that they can proceed with the production. Therefore these raw materials comes under tied demand and the production comes under autonomous goods. So for the purpose of production, it is what type of demand means independent. Production which is always independent, but for that raw materials used to depend upon the production. Therefore these type of goods are elastic, and the tied demand, the dependent goods are inelastic. Price range, either high price or low price. So here Veblen effect or given goods. In this stage it is used to come under inelastic demand. Already we have discussed Robert Giffen, one who given the statement on a Veblen goods, a Veblen effect or Giffen goods. So especially for these type of goods, the bread price, even which goes on increasing, but they won't switch over to other commodity. Instead of that, still they used to have the same in order to procure the same commodity, which might be applicable even the price may be low or even the price may be high. Comes under category of Giffen. And what type of demand? Here it is inelastic demand. And some amount of goods where the goods are in normal price range, there is no high level as well as no lower level, but always commonly they used to fix the normal level. But for those type of goods, for normal price range, always elastic. Why normal price range it is always elastic? Means people will show their interest in buying the commodity in case if there is no changes in the price. During that time always there will be a gradually quantity demand may be increase with regard to the change in price. But here either high price or low price, especially I given the example on Giffen goods, which is used to comes under inelastic demand. So in this specific heading, the determinants of price elasticity of demand, you need to identify what categories whereas elasticity of demand and inelasticity of demand might be applicable. So these are the various points which clearly explains on the concept of elastic and inelastic demand. So any questions to interact through the chat box, please let me know on determinants of price elasticity of demand, students. The next one is theory of consumer behavior. The next heading is theory of consumer behavior. So this theory of consumer behavior, utility. So want utility means want satisfying power of a commodity, and this utility may be varies from person to person. So in this case, to analyze, there are two important points. One is marginal utility, which comes under cardinal approach. Another one is indifference curve analysis. Hicks and Helen, this indifference curve used to comes under ordinal approach. So utility, maximum amount of satisfaction. So satisfying power of a commodity, it depends upon the consumer, but it may be vary from one person to another person. So especially on this specific chapter, the most important concept is marginal utility, and the another one is indifference curve analysis. Marginal utility deals with the dash approach. ordinal approach. Cardinal approach. Marginal utility deals with cardinal approach. Indifference curve deals with dash approach. Then ordinal approach. For indifference curve analysis derived or examined by Hicks and Hallen. But at the same time, marginal utility Alfred Marshall. So these are the points are important for your examination. Marginal utility, cardinal approach, Alfred Marshall. Indifference curve analysis, Hicks and Hallen. Approach is ordinal approach. Now, properties of indifference curve analysis. The properties of indifference curve analysis. So there are two. One is good A, another one is good B. So they both should have, point number one, same level of satisfaction. Same level of satisfaction. Point number two, downward due to budget consumption of one goods increases, other goods decreases. Goods A increases means, and this one started to decrease. Now just see, started to slope downwards. What purpose this curve slope downwards? Due to the reason of budget consumption of good A, which leads to decrease for good B. Third point. For this third point, it is convex to origin never intersect each other. For this, again goods A as well as good B, for this curve shift to right due to income increases. If it is shift to left, then income of consumer falls. Third one is budget line. So here the properties of indifference curve, it is very much important. There are two goods may have same level of satisfaction. Downward, where the budgets of one goods increases, other goods started to decrease. But at the same time, when we are discussing about two goods, there is a possibility of never cut each other, intersect each other, and at the same time convex to origin, called indifference curve analysis. The next one is consumer surplus. This consumer surplus derived from DMU, called diminishing marginal utility. So it has been derived from diminishing marginal utility. So what is meant by consumer surplus? What a consumer is ready to pay less what he actually pay, called extra satisfaction. So consumer ready to pay less what he actually buys comes under extra satisfaction. But for this there is an important concept to be understood. The diagram will be like this. Marginal utility, the shaded area, always MU is greater than price, therefore MU equal to price. Quantity, consumer surplus equal to total utility minus total amount spent. For examination point of view, consumer surplus equal to total utility minus total amount spent, and the another point is this marginal utility, always this portion, marginal utility always greater than price. Another important point for your examination. Marginal utility, the meaning of marginal utility, first amount of consumption of goods or services which gives more utility than the second and subsequent, with continuing reduction for greater amount. Say for example, number of total utility, marginal utility. So as per this diagram, this table, now just see here, 50 marginal utility, 50 plus 40, 90, 90 plus 20, again 10, 125, then last one is used to comes under negative. So 50, 40, 90, 90, then again 20, 120, 120, 110, again 10, 120, 120, again 5, 125, 125, again 5, 120, comes under negative. So for this, the diagram always will be like this. total utility, marginal utility. Now just see here, marginal utility it becomes negative since -5 it becomes started to becomes negative. Okay, so total utility started to increase, both are same. Later the total utility started to decrease, marginal utility it becomes negative. Now as per this table, total utility started to increase, marginal utility started to decrease. After intersect at one stage it becomes negative. So this table which shows either goods and services more utility than the second and subsequent, with continuing reduction for greater amount which is possible in the marginal utility. So as per this table, just see the marginal utility. When number of units started to increase, our utility started to decrease. So 50 means first amount of consumption, 50, which gives more utility than the second and third one. Second and third started to decrease. So always first one. So this process of continuing reduction for greater amount at last becomes negative, called as marginal utility. So consumer surplus, marginal utility we have discussed. So here you will expect one word question. Point number 1. When total utility increases, marginal utility decreases. This one started to increase, this one started to decrease. Point number 2. Total utility maximum, marginal utility is 0. This portion it becomes maximum, but here it becomes 0. Point number 3. When total utility falls, started to decrease, but marginal utility it becomes negative. So these points very much important for your exam. Then law of supply. So this law of supply concept is simple. When price increases, same way quantity demand increases. Price decreases, quantity demand will be decreases. So this law of supply, which refers to amount of goods or services, means producers willing or able to offer to market at various prices during a period of time. So supplies point of view, always you need to supply the commodity, but when you will expect to increase the supply means once the price which is started to increase in the market, the supply also will be increased. In case in the market where the price started to decrease means then the amount of supply also will be reduced. So that's why here I mention when price increases, quantity demand will be decreases. When price decreases, quantity demand also will be decreases. Therefore here what type of relationship means direct relationship. In law of supply, direct relationship, but in law of demand, inverse relationship. Price increases, demand decreases, price decreases, demand will be increases. Inverse relationship, but here direct relationship. For supply, price, quantity supplied. So now just see here, when price started to increase, quantity supply also started to increase. When price started to increase, quantity supply also started to increase. Therefore, like this, price increases, quantity demand also will be increases. Price increases, again next commodity, again here like this. As such, price goes on increases, quantity demanded, quantity supplied also will started to increase. So price increases, quantity supplied also started to goes on increasing. It is called as law of supply. But in short run cannot increase supply. Most important point, in short run we cannot increase supply. In long run supply can be adjusted in response to change in price. Now just see here, short run, in short run we cannot increase the supply, important question. But in long run supply can be adjusted, the supply can be adjusted in response to change in price. So based on change in price there will be a possibility to do some changes in supply, but in short run there is no possibility to increase the supply. So this part important question. Next one is shift in supply curve. Supply curve normally like this, either decreases, either increases. Other than price of commodity, supply curve shift always right to left. Important. Supply curve always shift right to left. For that, price, quantity, again Q1, S, S1. So this portion Q2, Q1 increase. Started to increase. Okay, so this portion, this arrow mark, increase in supply. Same way same price, quantity supplied, Q1. Now S1, yes, but for this Q2, Q1. This diagram which represent decrease in supply. So this part increase in supply, and this one deals with decrease in supply. Movement along supply curve. The price of a goods changes either upward or downward on same supply curve. Say for example, same supply curve P2, P1. Price increases, price decreases, upward, downward, upward, downward, but the supply curve is same. This portion is called as supply curve. Supply curve is which represents same. Now here Q2, Q1, Q2, Q1, decrease, increase, but supply is movement. Price of your goods changes either upward or downward. Movement on same supply curve is called as movement on supply curve. So here this part is important for your examination. Determinants of supply. Determinants of supply. The price of goods. Point number 1. Price increases, supply increases. The reason is higher price shall yield profit more. Point number 2. Price of related goods. For example, price of wheat increases, then the farmer will shift one commodity to another. Here another means example wheat, to get higher profit. Factors of production. Whereas cost of building increases, then there will be a high impact on corporates to increase infrastructure but negligible impact on agricultural business. So factors of production deals with land, labor, capital and organization. So once the cost of building price started to goes on increases, the people will show more amount of interest to have to increase the infrastructure, but at the same time they may show some negligible impact on agricultural business too. So here price of related goods, price increases, supply also will be increases. What purpose? The price of goods price increases, supply increases means to yield the high profit within short span of time. Point number 2, price of related goods. So one goods price increases, say for example even farmer, he switch over from one commodity to another commodity due to the reason of price started to increase. Again here, what is the reason? What purpose is switch over from one commodity to another commodity? Means the reason is to get the more amount of profit. Then technology, the invention plus innovation can bring better products. So technology, which represents 2 points, one is invention, another one is innovation. So both are very much important to bring new products to the society. So due to this reason, what will happen? The innovative products, the better products started to increase, but fall in supply of outdated product. So due to this outdated product, supply will be decreased. Due to the reason of invention as well as innovation started to enact with the new amount of products in the market, the supply started to increase, called a technology. And the next one is government policies. Government policies. Huge tax, whereas supply will be less due to low profit. The another major important reason, many places, for example Tirupur district, which was affected their production because of enacting the Goods and Services Tax Act in the year 2017. So what is the reason? The government, whenever they are going to increase the tax, whereas this may affected to the suppliers in order to yielding the low amount of profit. So since they are getting low amount of profit, during this stage what will happen? The supply will be less. So they won't show much more interest to increase the supply, especially once the government started to increase the tax rates. Other factors which used to influence the law of supply, point number 1, natural factors. So better rainfall is required, Point number 2, goal of the firm. Market structure. Foreign policies. So all these are the other factors. So once the natural factors, especially when better rainfall through the agricultural activities where there is a possibility to increase the production, the supply shall be increased. As well as the goal of the firm, what is the major goal of the firm means they have to increase the profit, but for that increase the profit means whatever the points so far what you have discussed, which not to influence or not to have much more impact on the amount of goods as well as the impact on the supplier, this may be reflected in reduce the supply. So till here what you have discussed, law of demand, law of supply and determinants of law of demand, elasticity of demand, market demand, individual demand, then various types of demand and determinants of supply we have discussed. So now the next important concept is theory of production. Theory of production. This theory of production also you will expect some amount of questions for your examination, especially few important concepts which we need to discuss in detail on theory of production. So here what is meant by production? Creation or addition of utility. In very simple concept of production is transforming resources into finished goods and services. So whatever the resources are available, so those resources are going to convert it into finished goods and services. It is called as production. Same way, money, expenses incurred in transforming resources into final product called cost of production. So for the purpose of creating, there are various types of utility: form utility, place utility, time and personal utility. So here first point, the meaning of production is transforming resources into finished goods and services. And what is meant by cost of production? Cost of production means for the purpose of transforming resources into final products, where we are going to expend some amount of money exclusively for the purpose of production is called as cost of production. So in this creation of utility, there are four types: form utility, another one is place utility, third one is time utility, and fourth one is personal utility. Farm utility, changing of log of wood with the help of wood, where you are going to transform or convert into finished products of table or chair. It is called as farm utility. For example, changing wood into table, one resources into another finished products, called as farm utility. Place utility, removing gold from gold mines and supply them to market. Time utility, preserving fruits so that they can made available even off season, called as time utility. Personal utility, personal skills, making use of personal skills. Example, merchant, where he is showing his interest in selling the product, used to comes under personal utility. So farm utility, place utility, time utility, personal utility. Transforming one resources into finished product, farm utility. Place, removing gold from gold mines and supply them to the market, place utility. Time utility, preserving certain amount of goods, especially preserving foods, and try to see those goods are available, those fruits are available even during off season, called as time utility. Where the merchants or organizers, they have engaged themselves in using their skills, then it is called as personal utility. So these are the basic information let you have to understood on the various types of utility engaged in the process of production as well as cost of production. So that's why I given the difference between the production as well as cost of production. So what are various factors of production? The factors of production. So examination point of view, you will expect some questions. First one is natural resources. Example here, land. Then capital. Third one, human resources, called labor. Fourth one, entrepreneurship. Organization. Land, capital, labor. Labor, what you have to do? You have to pay wages. Okay. Land, rent. Capital, interest. Organization, profit. So these are all called factors of production. Especially they will ask the question in land as well as labor. Labor is inseparable from laborer. It is first important question for this point. Labor is inseparable from laborer. One important question. Another one is labor is perishable. Labor is perishable. Sir, now what is the meaning for labor is perishable? See, once the day ends, okay, we cannot recover back the labor lost for that specific day. So once he has allocated with the amount of work, in case if he has not yet returned to do the work on that specific day, he has lost the work. So in such cases, we are calling it as labor is perishable. So various factors of production. Next one is cost. So in this cost there are two types of analysis. First we need to know cost analysis is presented, also production analysis. Cost analysis as well as production analysis. Cost analysis is the financial aspect of production. Cost analysis is financial aspect of production. Sir, financial aspects, okay, what is the meaning of financial aspects? Financial aspects means price of input, cost of output. What is meant by production analysis? Production analysis deals with physical aspect of production. Now physical aspect means what? Physical aspects is nothing but scale of production. So here cost deals with financial aspects of production, especially price of input as well as cost of output. In the production analysis, this financial aspect may not be presented. Instead of that, physical aspect is presented. Actual amount of production which is required to analyze the production, it is called as production analysis. So there are various types of cost concepts. So what are various cost concepts? First one is accounting and economic cost. Outlay and opportunity cost. Direct and indirect cost. Fixed and variable cost. So these are the major cost. First one is accounting and economic cost. Accounting and economic cost means payment and charges made by an entrepreneur to supplier. It is also called as explicit cost. Also called as explicit cost. Therefore, the economic cost equal to implicit plus explicit cost. Implicit plus explicit cost. Now what is the meaning of implicit cost? Implicit cost means the cost of factors owned by entrepreneur himself. So he need not to depend on others. So whatever the factors which are available with him, where he is ready to incur some amount of cost for the organization, called as implicit cost. So here first one deals with accounting and economic cost, payment and charges made by an entrepreneur called accounting cost. This one is called as accounting cost, also called as explicit cost, made by an entrepreneur, means out to whom? To the supplier, which represent explicit. But another cost is there, economic cost. This economic cost which represents both implicit and explicit. So explicit already we have discussed. Now what is the meaning of implicit? The cost of factors owned by entrepreneur himself, then it is called as implicit cost. So when we include both implicit plus explicit cost, okay, implicit plus explicit cost equal to economic cost, point number 1. Then the next one is outlay and opportunity cost. Outlay cost, first one, outlay cost. Actual expenditure on wages. Outlay cost means actual expenditure on wages, raw material, interest, rent. So all these expenses recorded in the books of accounts. So these expenses are recorded in the books of accounts, called as outlay. Outlay which represent actual expenditure. Sir, actual expenditure on what? Wages, raw materials, interest, rent, and same to be recorded in the books of accounts. Hence it is called as outlay cost. Opportunity cost. Opportunity cost. Opportunity cost, cost of foregone opportunity. So investing the capital, when you are decided to investing the capital somewhere, the return earned from such investment, where you have invested the amount of capital in somewhere, but unexpectedly you are getting some amount of investment, some amount of return from the investment, it becomes our opportunity cost. But almost these type of opportunity cost are not recorded in books of accounts. Here you will expect the question, which cost will record in the books of accounts? Only outlay cost used to record in the books of accounts, whereas opportunity cost are not going to record in the books of accounts. Third one, direct cost. So this direct cost identifiable to a particular product. Direct cost means cost identifiable to a particular product. Example, raw materials. So raw materials used in a particular product is called as direct cost. Very easily you can able to identify the amount of cost to be incurred for the purpose of production with the help of raw materials, called as direct cost. Indirect cost, not readily identifiable. Next one, indirect cost, not readily identifiable. So it is not very easy to identifiable or traceable. Okay, example, electric, power, salary of accounts manager. Okay, all these are all the example. Electricity or power, it depends on the usage only where you have to make the payment. So that's why here it cannot be identifiable or traceable. Therefore it is used to call indirect tax, not readily available. Example, electric or power. The next one is fixed cost, then variable cost. Fixed cost, here variable cost. Fixed cost does not vary the change in value of output, does not vary in the change in volume of output. Example, rent, interest, call fixed cost. These costs are totally unavoidable cost. Unavoidable cost. Hence it is called as fixed cost. Okay, unavoidable, uncontrollable, or the cost can be avoided only when the operations of the business are completely closed. In that situation only you can able to avoid the cost. Once the factory started to closed for a certain period of time, whereas cost can be avoided. Other than this, at any cost, here rent or interest comes under the category of fixed cost, does not vary in the change in the volume of output, but directly vary with output is called as variable cost. Directly vary with the output is called as variable cost. Say for example, 1 kg of raw material required for manufacturing 1 unit, then the raw material cost is 100 per kg. Therefore, when 50 units are manufactured, then the raw material cost is 5000. Same way, 100 units are manufactured, then the raw material cost is 10,000. So likewise, variable cost vary with what? Output. How much amount of raw material where you have decided to incurred, based on that the cost, okay, the cost also started to increase. So material cost, the number of units started to increase, raw material cost also started to increase, same way production cost also started to increase. So directly vary with the change in output. Whenever you are doing some changes in the output, this may be reflected in the other cost also. Hence it is called as variable cost. So here we have discussed accountable and economic cost, outlay and opportunity cost, direct and indirect cost, then fixed and variable cost. Then cost function. Cost function. So it is a mathematical relationship. It's a mathematical relationship between cost of a product various determinants of cost. So it's a relationship between one is cost of product, another one is various determinants of cost, called as cost function. Okay, so how this relationship will happen? But for that, dependent variable unit or total cost. Same way, independent variable price of factor or size of output. So now just see here, dependent and independent. The cost of the product as well as various determinants of cost, unit cost or total cost, various determinants, price of factor as well as size of output. So dependent and independent variables. It's a relationship. What type of relationship? Mathematical relationship. Hence it is called as cost function. But this cost function deals with two run. One is short run another one is long run. Concept of total revenue, marginal revenue, average revenue. Very, very important concept for your examination. Concept of total revenue, average revenue, marginal revenue. Total revenue equal to P into Q, whereas price Q equal to quantity demanded. Same way, point number 2, average revenue equal to total revenue divided by quantity, or P into Q divided by P into Q divided by Q to P. So Q, which represents quantity sold, TR, which represent total revenue, P, which represent price of goods. Marginal revenue, MR, called marginal revenue, change in total revenue divided by change in quantity. Okay, change in total revenue divided by change in quantity is called as marginal revenue. So examination point of view, total revenue, price into quantity, price, quantity demanded. Average revenue, formula TR divided by Q, total revenue divided by quantity, or you can use this formula, price into quantity divided by same quantity equal to price. Marginal revenue, formula is change in total revenue divided by quantity. But in these three, total revenue, average revenue, margin revenue, at least one question you will expect with regard to the problems for your examination. Types of production function. There are two types. One is short run, another one is long run. Short run, law of variable proportion. Long run, law of returns to scale. So in this law of variable proportion, total product, marginal product, average product. So law of variable proportion, total product, total output produced. Marginal product, where change in total product per unit, change in quantity of variable factor. Average product, total product per unit of variable factor. Law of returns to scale, all the factors are variable, and also increase, decrease in same proportion. So here law of variable proportion, the diagram will be like this. Marginal product, average product, total product. So these places intersect, which represent stage 1, and this one comes under stage 2, and this which comes under stage 3. So output, variable factor. So stage 1, stage 2, stage 3. These 3 stages. First stage, stage 1, increase. In this, AP is average product is maximum, that is point P, this point P. MP curve reach maximum point. In this case, average product, marginal product, total product, all these 3 products started to increase. Total product increases rate, total product increases, whereas marginal product also increase at increase rate. This is first increasing stage. Second stage is diminishing stage. In this stage, MP, marginal product, falls due to total product increases at diminishing rate, and average product also falls. Third one, negative stage, total product falls, average product falls, and marginal product is negative. In law of return to scale, stage 1, stage 2, stage 3, stage 1, stage 2, stage 3. Here change in scale, scale 1, scale 2, scale 3. Change in scale means all factors of production increase or decrease in same proportion. Increase or decrease in same proportion. In this, all the factors are variable factors, increase in this scale. Increase at first, the marginal product increases, becomes constant, and started to decrease at a certain limit. So these two are very much important for your examination. So first what you have to do is types of production. How many types? There are 2. One is short run, another one is long run. Short run deals with law of variable proportions, mark it as important. Long run deals with law of return to scale. So in this law of variable proportion, there are three. One is total product, average product, marginal product. In these three stages, which stage it is very much important? Stage 2 is very much important. In first stage, all total product, marginal product, average product all started to increase. But the second stage, marginal product falls, diminishing stage, due to total product increases. Due to this product increases, marginal product started to falls. At one stage it becomes negative, third stage, negative stage. So when total product, marginal productivity product falls, total product started to increase at diminishing stage. At this stage, average product started to decrease. But negative, total product decreases, third stage, average product decreases, but in this stage marginal product becomes negative. So this portion is very much important for your exam. Now what about the law of return to scale? In this, all the factors are variable factors, but either increase, scale either increase or decrease on same proportion. It is used to increase or decrease in the same proportion. Even here, stage 1, stage 2 and stage 3. But change in scale means all factors of production either increase or decrease, but on what proportion? Same proportion. Hence it is called as law of returns to scale. So in this production function, there are two types of production function. Okay, we have discussed with the law of variable proportion and law of returns to scale. And another important production function is Gauss production function. What is the formula for this? Q equal to KLAC it's a very much important formula oriented question. Okay, Q which represent quantity, Q which represent output, L which represent quantity of labor, C equal to capital K and A are constant. Through this study, found that 3/4 of labor contributed and capital 1/4 capital increase in manufacture production, so formula for Gauss production function, this is the formula. Q which represent output and L quantity of labor, C capital and K and A are constant. What purpose they are using this Gauss production function means this which has been derived from statistical study. And another important thing is the given function is linear and homogeneous. It shows constant returns to scale. This Gauss function shows what returns to scale? Constant returns to scale. Constant return to scale, mark it as important. And now classification of market. So classification of market, there are various classification of markets are there, whereas perfect competition and imperfect competition and monopolistic competition and oligopoly. So all these are all various types of competitions which are applicable in the classification of market competition. So perfect, another one is monopoly, then monopolistic, then oligopoly. So market means what? Market is a place where buyers and sellers used to meet each other in order to bargain over a commodity for a price. So what are elements in the marketing? Elements of market. Point number 1, buyers and sellers. Point number 2, product or service. Point number 3, bargaining for a price. Then the next one is they should have knowledge about market. Then one price for a product at a given price. Buyers and sellers, product or service, bargaining power, knowledge about market, one price for a product at a given price. These are all the elements of market. Classification of market. Apart from market structure, there are various classification. One is area, another one is volume of business, third one is time, then fourth one is nature of transaction, then regulation and competition. So what are various classification? Area, volume of business, time, nature of transaction, regulation and competition. These are all the various classification of market. Area means local market, regional market, national market, international market. Area. Volume of business. Volume of business is nothing but wholesale and retail. Time period, very short period. Perishable goods used to comes under short period. Example, vegetables. Short period, very short period, long period and very long period comes under time. Fourth one, nature of transaction. Spot market as well as future market. Goods are physically used to transact on the spot is called as spot market. Okay, contracts on future date is called as future market. Nature of transaction. So area, as I told, local market, regional market, national, international. Then volume of business, wholesale business, retail business. Then for the time, very short period, long period and very long period. Then nature of transaction on the spot, then spot market. Contract on future basis comes under future market. Regulated market, statutory body, say for example SEBI is a statutory body, comes under regulated market. If there is no restriction, then it is called as unregulated market. Then the competition only here, this competition only which represents perfect competition. Another one is imperfect competition, monopoly plus monopolistic plus oligopoly, called as imperfect competition. Okay, so these are all the elements are required to be satisfied. So in the competition there are two. One is perfect competition, another one is imperfect competition. In the imperfect competition, monopoly, monopolistic, oligopoly, imperfect competition. Okay, so from first one is the meaning of market, then classification of market. Totally 5 classification is there. Last classification is competition. For that competition divided into 2, perfect and imperfect competition. So here comparison of different markets. So here I have quoted there are perfect competition and imperfect competition. Perfect, monopoly, monopolistic, oligopoly. So what is the major comparison between these markets? Okay, first one is point, perfect competition, then monopolistic, monopoly, perfect competition, monopolistic, monopoly, oligopoly. The comparison. First one is number of buyers and firms. In this case, many buyers, sellers selling identical goods. Here same many buyers but differential product. Here single seller, many buyers. Here few sellers selling competing products. Next one, price elasticity. Here it is infinity, greater than 1, less than 1, here also less than 1. Control over price. Price taker, price maker, price maker, some control over price. nature of product, homogeneous product, differentiated product, but close substitutes, unique product, either differentiated or unique. Depend on oligopoly. Entry and exit. Here it is free, restricted, so this table is very much important for exam. Now just here, as per this table, there are 4 classification. First classification, number of buyers and firms. Perfect competition, many buyers and sellers, identical goods. But here monopolistic competition, many buyers but they used to sell differentiated goods. Monopoly, sellers, single seller but many buyers. So there is a difference. Many buyers used many sellers. Many buyers but they used to sell differentiated products. Single seller but many buyers. Oligopoly, few sellers selling competing product. So each competition on number of buyers and firms, it may not same. Differentiation is there between these types of competition. Now just see price elasticity. Okay, less than 1, small, more, and here it is infinity. Price elasticity of demand in perfect competition is infinity. In monopolistic competition, greater than 1. But here in these two, monopoly as well as oligopoly, the elasticity of demand is less than 1. Control over price. Here they are price taker, but here they are price maker. They can control over the price. Price maker is applicable for 2 types of competition. Whereas monopolistic competition, monopoly, they are price makers. But in oligopoly, somehow they can able to control over price. Nature of product, homogeneous product, differentiated product, identical product, homogeneous product, differentiated product but close substitutes. But here unique product, single seller, unique product, either difference or unique product depend upon oligopoly. Okay, since the oligopoly means what I told, few sellers selling competing product, it depends where they have to focus on differentiated products or the unique products. They depend upon the oligopoly. Entry and exit. Here free entry. In perfect competition, where they can enter in doing the business, also once they have decided they can exit. So entry and exit is easily applicable in the perfect competition. Same way it is applicable in the monopolistic competition. But it is not very easy in the monopoly since their investment is very, very high. The entry and exit, lot of statutory requirements also which is required for monopoly. So restricted, not only in the monopoly it is restricted, even in the oligopoly also entry and exit is restricted. If you understood these concepts, how far the each and every characteristics which is totally differ with the one competition with the other competition. The perfect competition comes under the category of the perfect but other rest of the three imperfect competition, monopolistic competition, monopoly and oligopoly, all the characteristics what we have discussed, it may not same, each one which is differ from one competition with the other competition, especially for 2 points. One is control over the price. As I told here, the two competition, monopoly and monopolistic competition are same way for price elasticity, monopoly and oligopoly is same, and same way for entry and exit. Perfect competition, monopolistic competition is free, but at the same time it is restricted on the rest of the two. One is monopoly as well as oligopoly. So this diagram is very much important for examination. Other one is a duopoly. There is a demand curve called kinked demand curve. This one is also called as Sweezy model, like this. This portion called as demand elastic, and this portion comes under demand inelastic. So in this case, firm fix lower price so that demand for product increases, and the another one is inelastic. So this part is very much important. Since the firm is going to fix the lower price, there is a possibility on what, let the production can increase, called as what type of demand curve? Kinked demand curve. And another one is duopoly. Duopoly means only two firms. Monopsony means single buyer of product. Oligopsony, small number of large firms. Bilateral monopoly, single seller and single buyer, single seller and single buyer. So all these are all the important relative terms. The next one is business cycle. This business cycle used to refer to alternative two things. One is expansion, another one is contraction of business activity, such as gross national product, employment, and income. So gross national product, employment, and income. So for this business cycle, here expansion stage, peak stage, contraction stage, trough time, another one is real GDP. So for this there are 4 type of stages. One is expansion, another one is peak, another one is contraction, and the 4th one is trough. So even here expansion stage, increase in national output, employment, full employment, price and cost started to rise, high standard of living, now next stage is peak stage. It is highest point of business cycle. Input increases, output increases, input and output price increases, actual demand stagnate, contraction, fall in investment, producer anticipate, higher level of demand, stoppage of production. In this stage, severe form of recession, growth rate becomes negative, causes of business cycle. There are 2 causes. One is internal, another one is external. External cause, the reason is war, post-war, technology shock, natural factors, population growth. Internal fluctuation in effective demand as well as investment, variation in government spending, macroeconomics policies, money supply, psychological factor. Now indicator, point number 1, measure business cycle as well as predict where the economy headed towards. For this, one is leading indicator, lagging indicators, coincident indicators. So leading, lagging as well as coincident indicators. Now here leading indicators. This one used to indicate before the economy started to follow a particular pattern. Point number 2, lagging, based on historical performance only after a economic trends or pattern already occurred. Coincident means concurrent indicators. This is also called as concurrent indicators, used to occur simultaneously with business cycle movement. Example of business cycle: global economic crisis. So now duopoly. There are two firms in the market is called as duopoly. Monopsony, single buyer of a product. All these are all one word questions. Oligopsony, small number of large firms are applicable in the market. Bilateral monopoly, single seller as well as single buyer is called as bilateral monopoly. Now the meaning of business cycle. Next one, the most important chapter, business cycle. This one used to refer alternative. Alternative means one is expansion, another one is contraction of business activity. Here expansion, here contraction, then peak stage, then trough or depression stage. So there are 4 stages are there: expansion stage, peak stage, contraction stage and depression stage. Okay, so what are all the examples for the business cycle? Means used to find out the national product, employment and income. Now just see here, there are 4 important points as I told already: expansion, peak, contraction, trough. This table is very much important. This table is very much important again. The reason is they will ask the question on full employment which is applicable in the dash phase of business cycle. Full employment comes under expansion. So once you know on the various factors which is used to comes under the different phases of cycle, only can able to mark the answer. Increase in national income and output comes under dash phase of cycle, expansion. Fall in investment comes under dash phase of cycle, again contraction. Demand, the supply exceed demand comes under dash phase of cycle, again contraction. The growth rate of economics becomes negative, comes under dash phase of cycle, again trough. So like this, increase, price and cost also will be increased, high standard of living will be there, but this may be possible only at the initial stage of expansion. So started to expand, slowly started to decrease. Meanwhile there will be a peak stage, high amount of business cycle. Either price input also will be increases, price output also will be increases. So it is a actual demand to stagnate. Contraction, producer anticipate high level of demand as well as stoppage of production during this stage. Since there is a fall in investment, and due to this it is used to reflected in the stoppage of production. Trough means it's a depression, last stage, depression stage. The growth rate of economics also will becomes negative, and severe form of recession will be there during this particular stage. So as I told earlier, you will expect the questions, price input also increases, price output also used to increase under dash phase of cycle, means then the answer is peak. So like this you will expect the questions on the various phases of cycle. So this business cycle used to cause, there are 2 different factors: internal factors, external factors. Okay, so even here it is important, war and post-war, which is used to affect the dash causes of business cycle, external causes of business cycle. Technology shock, natural factors. So all these factors comes under the category of external, which includes the population growth. Fluctuation effective demand, on and off there will be a changes in the demand, not only demand, even in investment. The government is not ready to spend, but there will be some variation in the government spending. Also macroeconomic factors, money supply and psychological factors. All these are all the examples which may cause. What type of cause? Means internal causes of business cycle. So there are 2 types of causes of business cycle. One is internal cause, another one is external cause of business cycle. But for that, each and every point what we have discussed with the internal and external, it is very much important for the examination. So it is, you need to focus on each and every heading. Indicator. Sir, what is the meaning of indicator? Yes, this indicator also is just a term which represent to measure business cycle, how it is, we can able to predict where the economy headed towards, in what stage the economy at present which is prevailing. But for that, to identify or to predict earlier the business cycle, which is a most important format where we are applying here, means it is called as indicator. So even here there are various types of indicators. First one is leading indicator. So before the economy started to follow a particular pattern, okay, through that pattern whether we can able to get the economic growth can increase or decrease to be identified with the help of leading indicator. Lagging indicator, it's an historical performance. Okay, only after a economic trend or pattern already occurred, based on that earlier what which has happened, it is used to reflect the historical performance, and changes in the indicators are used to observe only after a economic trends or pattern already occurred, called as lagging. Third one is coincident. Coincident is also called as concurrent indicators. It is called concurrent indicators, simultaneously used to work with business cycle movement on and off. It is used to check with the coincident. As I told, it is occur simultaneously along with the business cycle movement. So what are the examples of business cycle? Okay, so Great Depression, which was happened in the year 1930, or information technology bubble burst of 2000, and last, the most important thing is global economic crisis 2008 to 9. All these are all comes under the examples of business cycle. Okay, so now we are going to have some discussion on the one word questions. Question number 1. Perishable commodities will have A, perfect elastic curve, B, perfect inelastic, C, elastic, D, inelastic. So perishable goods, you know very well, it cannot be stored for a long period of time. If stored, the same will be wasted. So supply is limited and it cannot be changed in short run. Therefore, the answer is perfectly inelastic curve. For that I have given the explanation why it is used to come under the category of perfectly inelastic. Second question. Law of demand relates to A, price, B, price and quantity demanded, C, quantity demanded only, D, supply. So here law of demand relates to, you know very well, both which is required, price and quantity demand is the answer. For this, perfectly inelastic. Then third question. Goods which are inferior with no close substitutes easily available. A given, B conspicuous, C conspicuous, C speculative, D prestige. Even goods which are inferior, okay, inferior goods easily available but there is no close substitutes, okay. So always used to reflect direct relationship between price and demand called given goods. Therefore answer is given goods. So these goods always are inferior, they don't have any close substitutes, even they can occupy a substantial place in the consumer's budget. The law of diminishing marginal utility is derived from A. Indifference curve, B. Consumer surplus, C. Maximization of profit, D. Expansion of firm. So for this question, the law of diminishing marginal utility is derived from, already we have discussed, the indifference curve is totally differ, okay, but this concept, law of diminishing marginal utility, is derived from consumer surplus. So why consumer surplus? It's a marginal utility which goes on increases, okay, each additional unit started to decrease. So law of diminishing marginal utility states that when consumption started to increase, marginal utility derived from each additional unit started to decrease. Therefore this law of diminishing marginal utility used to comes under the concept of consumer surplus. Again they will ask the question in different way. Consumer surplus is derived from which concept? So here we have discussed about law of diminishing marginality, it's derived from consumer surplus. Same way consumer surplus also derived from which concept? The answer is very simple, same thing, law of diminishing marginal utility. Law of diminishing marginal utility is the answer. With regard to cost, which of the following cost curve, which of the following cost curve is never U-shaped? A. Average total cost, B. Marginal cost, C. Total cost, D. Total fixed cost curve. Answer: total fixed cost. This total fixed cost curve, which remains same even the production total increases. So here it never becomes U-shape. Which one? Total fixed cost, it never becomes U-shape. with regard to cost, there is a possibility to ask practical question. Suppose total cost of production of commodity X is 1,25,000. Out of this cost, implicit cost rupees 35,000, normal profit rupees 25,000. Then what will be the explicit cost of commodity X? So they have given in the question, they have given total cost 1,25,000, implicit 35, normal profit 25. Then we need to find out explicit cost. Okay, now formula: total cost equal to explicit cost, implicit cost plus normal profit. Total cost already they have given 1,25,000. Explicit cost we need to identify. Implicit cost 35,000. Normal profit 25,000. Okay, so now 1,25,000 here, 60,000. So therefore explicit cost equal to 1,25,000 minus 60,000 equal to 65,000, called as explicit cost. So like this can expect the question for examination on cost. Next one, what is the total cost of production of 20 units if fixed cost is rupees 5,000 and variable cost is rupees 2? A 5,400, B 5,040, C 4,960, D 5,020. Total cost equal to formula: fixed cost plus variable cost. So here we need to find out only the total cost, but they are given the fixed cost 5,000 plus how much amount of units? 20 units production. So therefore 20 units of production, per unit cost, variable cost rupees 2. So answer is 5,000 plus 40. 5,040 is the total cost. So answer is B 5,040. So cost related you will expect the problems. So that's why there are two problems we have discussed. Now eighth one, marginal cost changes due to change in dash cost. A total cost, B. Fixed cost. C. Average cost. D. Variable cost. So here they are given, there are four options: total cost, fixed cost, average cost, and variable cost. Why variable cost? Means for the variable cost, changes in the level of output can be happen in the short run. So marginal cost means what? It's an addition made to the total cost by the production of an each and every additional unit of output. Therefore, for this marginal cost due to change in dash cost, the answer is variable cost. Now ninth one. Market which have two firms are known as oligopoly, duopoly, monopsony, so you know very well here only few sellers, monopsony, oligopsony. Now we have discussed. Okay, what a market have two firms means the answer is duopoly. Duo means two. Duo means two. Poly means seller. So how many sellers in the duopoly? Means there are two sellers in duopoly. Tenth one. Monopolist can determine A. price, B. output, C. either price or output, D. none. So monopolist firm is the price maker. In this market only the seller can influence the prices. So only the seller can influence the prices means he can determine either output or price. So the answer is in monopolist firm, okay, is a price maker. Since he is a price maker, he need to focus either price as well as output. So he can determine either output or price. Okay, so like this you will expect the questions for the examination. So for the today's session, we have discussed demand, supply, market, competition, cost, business cycle, consumer behavior. Till here, any questions means you can post your questions in the chat box. Or any questions to interact with me, you can ask your queries now through the chat box. So the next section tomorrow, the rest of the chapters where we need to focus in order to complete the business economics in simple and easy way of how to approach the economics to score good marks for CAI Foundation the examination. Okay, with this I will conclude this session. Thank you all.